Well, good afternoon and welcome to the Commercial Council webinar presented by the Commercial Council of the Greater Hartford Association of Realtors. These are informal monthly discussions on topics of interest to commercial realtors. My name is Mike Goman and I'll be your host for today's session. And today our guest is Professor John Glascock. Many of you know John from his involvement with the Greater Hartford Association of Realtors. But for those of you who don't, John is a professor, as I said, and he's also director of the Center for Real Estate and Urban Economics at the University of Connecticut. A quick bio on John, I won't read through it because it's very extensive, but among other things, he has his master's in land economy from Cambridge, his PhD in finance from the University of North Texas. He holds a master's in economics from Virginia Polytech and an MBA from Stetson University. John's areas of expertise are many, but they include real estate, REITs, housing policy, valuation finance, investment, and capital markets. And as I mentioned, many of us know, or most of us know John through his position as the director of the UCONN Center for Real Estate and Urban Economic Studies. John, so let me turn it over to you. John, I know you have some slides you were going to share. So why don't you go ahead and share those and you can kind of lead us through the opening of our session today.
Okay, do you see it, Mike?
There we go. Perfect.
Oops. It doesn't seem to want to, hang on a second. There we are. Wrong button.
That's all right.
Okay, this is a conversation with Mike Goman, and we're going to talk about the COVID and other things today.
Yep.
First thing I want to say to you all is something to keep in mind, because everybody asks me if this is going to be a fast recovery or a slow recovery. Well, one of the good news is I believe it's going to be a little bit faster than people anticipate. And the reason is lots of people have saved up money during this particular episode. Here, I just pulled this today from the Federal Reserve data. If you look at US savings rates in late 2000 and now 2020, then 21, people have saved over $1.6 trillion more than they would have saved in the same pattern in the last 2 years. So that money is kind of sitting on the sideline. And I think once people get their shots, once people feel comfortable, that money is going to come back into the marketplace. So it's going to help us to really kickstart the economy. Let me say a couple other things. Normally, we talk about Hartford still having trouble. Every year from 1950 up until basically 2010, every 10-year period, it lost population. But the first time since 1950, between 2010 and 2020, Hartford had a small increase in population. So I'm hoping that's a sign that they made a turn and more things are to come. But more important for us, if we look at the whole metro area. Now the metro area is important because Hartford itself is less than 10% of the whole metro area. So the whole metro area is what's important. And in the last 10-year period, the whole metro area grew by more than 6%. So the area is strong. The other thing is, as you know, housing demand is strong. Our only problem right now is inventory is a little bit low. So we're probably getting some price increases. Nobody's upset about that. Now, Let me say a little bit about COVID. And what I'm telling everybody is that, look, it did not start any new trends, but it has accentuated trends that were already in play. And I just want to talk about a couple of them, and then Mike and I may follow up with that later. The first is we saw more online commerce. Now, that's nothing new. We were already getting online commerce. It's just now that Walmart got a bigger share, Amazon got a bigger share. The commerce players that are online did even better. We also had been seeing more distribution infrastructure being built up near the airport here in the Hartford area and other places. Well, we saw even more of that committed, and we're going to see more of that committed the next 4 or 5 years. Again, it's a trend that we already saw, it just got accentuated. Alternative work settings. I'm going to come back and talk about that a little bit more on the next slide, but people were already looking for different ways to work in the city, in the burbs, and other places. The decline in the core city occurred fast. People left New York. They left Chicago. They left San Francisco. By the way, that's been occurring since 1920. That's not a new phenomenon.
Yeah.
However, something that people haven't quite caught, I believe, is distance medical care. Wyoming and Texas, before the epidemic, had been experimenting with having doctors online help patients in West Texas. Not enough doctors. They also authorized some of the drugstores, Walmart, et cetera, there to provide certain services. You could take a test, it could be sent to the Texas Medical Center, and then they could send back a prescription to that drugstore in West Texas, distance care. Wow, did this epidemic ever push that? More doctors have tried it. They found that it wasn't so bad. They could see more patients. Some patients didn't need to come see them. So what you're going to see is distance medical care is going to increase over the next 4 or 5 years. Now that people see it can work. It was there before, but it kind of jumped up. Okay, none of these are new, but they've all been pushed down the track by COVID-19. Alternative work settings. I want to go through a couple things. First is there's going to be less outsourcing to call centers in places like India. The public don't like them. They still don't like them. And industry people are catching that. And I'm told with the big players, whether it's the banks or whether it's service centers, more of those are going to be in the USA or Canada. Few are going to be in Asia. However, there's going to be more AI. When you call in to pay your credit card, like I do the other day, you're going to have to push the buttons and listen and answer the questions, and then finally say, yes, that checking account online is the one I'm using to pay my bill today. AI is going to be more prevalent. Slightly more is office hoteling in the cities, but don't expect a big bump. I'll tell you why in a minute. However, we're going to have more core in the city, but offices in the burb, kind of like an octopus. The head may be in the city, but there's going to be lots of sprouts out and more people will be out. That head's going to be smaller in the city. More work from home, yes, it will increase, but it's going to be close by and not distance. What Apple said was recently, if you want to work somewhere not close to us, we're going to cut your pay. And we may cut your pay up to 40%. So if you want to go to Denver, but you may take a 30, 40% pay cut. What people want, it's okay for you to be at home, but if I need a meeting at 11 o'clock, you need to be there. And you can't do it from Denver if you're in San Francisco. What we are going to see is something that's in the background, and people weren't talking about it, but firms are trying to work it out. And the epidemic's going to push it farther. Hub and spoke, but the hub will be in the burb or a livable city, a Charlotte, a Nashville, a Boise. All right. Here's what's happening. This occurred 2 years ago in New York. Some of the big firms, Citigroup, et cetera, tried to come up with a way to put more of their offices out. About 15 years ago, I did a consulting job in Washington, D.C. for a big firm there. And we wanted to put the hub out in Virginia. We want to have a small spoke in D.C., but we want to have some other spokes further out in Virginia to lower our housing costs. Now, here's the problem that Citigroup ran into and that we went into on that consulting job. When we surveyed our employees, too many of them had spread around the city. So if we went south to Virginia, all the Maryland people were upset. If we went north to Maryland, all the Virginia people were upset. Same thing Citigroup ran into. Given they were all kind of in Manhattan or Midtown, if we went over to Stanford, well, there were people on the other side of Manhattan who were upset that's too far to commute. So here's what you're going to see. More people are going to be allowed to work from home, but they're going to start moving that hub out to a Stanford, maybe even a Charlotte. And then as new people get hired, they're going to be told, your hub is Charlotte, your hub is Stanford. And then slowly they're going to move people away from that city center. All right. Now that's going to slowly catch on, and then it's going to get really fast. And you're going to see very few of the big corporations downtown in the cities. Everybody tells me, wait, Arlington. Hey, Arlington's not in the city. That's a burb in DC. Don't forget that. Now, one more time about the hubs. This happened once before, and people said, well, it's not going to happen, but it did. Remember, this bridge used to have to open in London because it's the only way you could get the freight into London to be distributed. The freight was distributed in the city. Today, no freight goes underneath that bridge. All of the freight's about 35 miles south on the river, all the distribution, and the city's now just a little hub. Transportation did this. They came out of New York. They came out of London. These core office centers are going to do the same thing for the exact same reason. It's going to take a little more time, but you've already seen this once if you want to go watch it. TIA CREF, UBS, Barings, and Apple, they're all already starting this trend. UBS is going to have one of their hubs down in Charlotte. Why? People who are not at the highest salary level find Charlotte to be a great place to live. They can get a great house. They got low cost of living. The commute's not bad. And it's an easy flight back to the East Coast if you have East Coast family here. Those kind of cities, and then the suburbs of the big city are going to get the hub just like those places outside of the big cities did in cargo years ago. Mike, back to you.
Yeah, so a terrific setup, John. A lot of great information. I appreciate that. The personal savings rate number, that first slide you put up, is really remarkable. Is that money that's sitting on the sidelines that you expect to see kind of come back into the market? And if so, is it deferred consumption and therefore it'll show back up in retail sales? There was some sort of indication that retail was popping back up again, but then February was not so good. So, do you see that? Is that people that they're going to use that money, or does that money stay in personal savings? What do you think happens?
Well, I think, first of all, most of that is not corporate, even though most of that's personal savings, people like you and me who've been locked down. But, I don't think you bought a new car recently, right, Mike?
Right.
I didn't buy a new car. I mean, I kept my Subaru because I don't want to go shopping right now for a car. All right. Mm-hmm. And so lots of people in that upper middle class category who kept their job, they've simply been saving extra money. Now, how fast will it come back on? I don't think it's going to be February, March, or April. I think this money is going to be 6 to 9 months away. They want to make sure when the economy opens up, they don't lose their job. Right. Okay. Some of these people are worried that, yes, they've been kept, but there's been government programs to encourage Delta to keep you, or to encourage United. Remember, United was going to lay off 6,000 people until the government gave them a grant to keep those 6,000. Now, if we don't give them a grant next year, see, some of those people are sitting there saying, hey, I better keep a little cash because next year United might lay me off. So once the economy comes back and you're kind of sure you're not going to get laid off, that money is going to come back into play. And most of it, I think, is going to be consumption. Most of it's going to be consumption.
Okay. We see it in our business, the amount of the number of malls that are in trouble. I mean, it's shocking, out of the 3,000 or so major regional malls, over 400,000 square feet in the country. If you deduct the top 100 markets and you say there's 6 good regional malls in all 100 markets, that's only 600, and we've got about 3,000. So what happens to the other 2,000 or 2,400 malls if this continues? I mean, the numbers are pretty shocking. And the value of these properties has dropped by 80 or 90% here in Connecticut. Of course, we've got Waterford Mall, Crystal Mall down in Waterford is in bankruptcy. Enfield Square Mall has lost its anchors other than Target. What do you see the future of those properties? Are they all going to be redeveloped as medical uses, or?
Well, first, Mike, I do think 3,000 malls is way too many. I'm not sure we'll drop to 600, but I do believe it's going to be under 1,000 when the adjustment's over. Now, part of this is, remember, not just online shopping, even though that's driving some of it, but part of this is our economy restructured between 1970 and about 2010. We used to have a big middle class. Some of that middle class became a little bit wealthier, okay? But some of that middle class became a little bit poorer. So what happened was that middle group of the middle class, the Lord and Taylor group, it's gotten so small, it's kind of not there. You either bumped up a little bit or you went down to, I'm going to call it the Walmart / Penny's market. Now, that crushed a lot of good Macy's stores, Lord & Taylor stores, Dillard stores, and they're going to go away. And what you're going to have is more practical shopping like Walmart plus Amazon. And then you have a fewer malls for destination shopping. Then you're going to have a few more high-end, but smaller centers. I don't want to call them malls, but they're going to be places where that new $200,000 plus family, $200,000 plus family is going to want to shop. And they're not likely going to shop at the regular mall anymore. Lord & Taylor's used to be at the mall there in West Hartford. I don't think you're going to see that in the future. I think there will be a much more niched operation, and your mall that's left will be destination general shopper malls.
Yeah. So when people start coming back to the old pattern, so to speak, as you pointed out, I think you're right. It's really an acceleration of previously existing patterns and a combination of online and so on. Let's shift gears a little bit and maybe do a bit of a rundown on national markets and get your thoughts on what's going on nationally. And we read a lot about the markets in the South, Austin and Dallas and Nashville and so on. They're the hot markets. Are they going to continue to be the active markets as some of these changes roll out, that some of the changes you were describing?
Yeah. Here's one of the tricks you need to remember. Around 1985 or so, the South became the largest part of the country. And by around 2050, if we take the current numbers, 1 out of every 2 Americans will live in the South. All right. That's just a phenomenal statement for somebody like me who grew up, the East was big, and then the Midwest was big. And then there was kind of that stuff out West, and then there was a little bit in the South. But today that's shifting. So if you look at your growth states, nearly all of them are across the South, and then a little bit up in Boise's okay, and then a little bit up in the Northwest. But the South is the hot area. It's Florida, it's South Carolina, it's Tennessee, Nashville corridor from Louisville to Nashville to Atlanta is a phenomenal corridor. Okay, you go over to Texas, go to Houston, up to Austin, up to Dallas, up to Oklahoma City. That's going to be one big corridor in just a few more years. Okay, and then of course you've got the Southwest, Phoenix over to San Diego, up to LA. Now, that growth area is going to continue. The group that's going to get hurt a little bit is the Midwest, particularly the older upper Midwest. Okay.
The Ohio's and so on.
Yeah. Well, and even I think if you look at Chicago area it's doing okay, but it's really not doing well. Minneapolis is doing pretty well, but if you say Columbus, it's okay. If you say Indianapolis, it's okay. It's not Atlanta. It's not Raleigh. You know what I mean? And on the East, Boston's the one that's pulling the wagon. The question is, can Boston continue to grow? And the answer is probably it's going to slow down because there's not enough around it for it to pull in the same way. Okay, unless they're going to pull things out of New York. And I don't think that's going to happen. I think the New York things that will be pulled away will go to Charlotte, will go to Atlanta, will go to Austin.
Yeah. So, picking up on some of your comments about the future of the center cities, the central business districts. So does it mean that, the Hartfords of the world are in a much better competitive position against Boston and New York versus, where they were, say, 5 years ago because of COVID and people working from home and the ability to work remotely? Does that mean Hartford's much better position than they were, say, 24 months ago?
Well, I don't think Hartford is, or somebody their size. I don't think Syracuse is. I don't think Hartford is. But I think Charlotte, Boise, Nashville. Now, there's a little bit of a scale factor here, Mike. What's going on is when you're in one of these young couples, and remember, young people today get married about age 31 to 35 if they're college graduates.
Right.
So that means when you come out of college at 22, you need to be in a city big enough to find that girl, if you're a guy like us. And it needs to be a big enough city while you're dating and you get married at 31, if one of us loses a job, the other, you can get a new job without having to leave the town. And the problem that a Syracuse, a problem that a Hartford has right now, they're just not a very diversified employment base. There's just not enough jobs to allow that to occur. Whereas if you're Boise, if you're Nashville, if you're Charlotte, now you're still not Chicago or Atlanta, but you're big enough that there's some real options. The other benefit is, Mike, you can buy a house in Charlotte or Boise and still commute into town without killing yourself.
Right.
Whereas Atlanta is a little bit tough. Dallas is a little bit tough. And so a lot of young people are thinking about that. in a way that's going to help those cities.
So the central city, what's the future of the central city district, the central business district? Does it mean that, you know, we read a lot in the press about New York's physical office occupancy being less than 20%. Hartford's sort of similar numbers. You know, does it go? I assume it goes back up at some point to some new number. But what is that new number? Is it 70%? Is it 80%? Or is it better than that? You know, what do you think? What's your prognostication?
Well, in the long run, I think more height office buildings in New York City will become condos. And matter of fact, if you look at the last 20 years, that's the trend we've been seeing. Net occupancy really was not going up in New York City. It was only going up where you took buildings out of the inventory to make them condos. So yes, you had fewer buildings. Now, let's go back a few years. If we looked at Houston or Dallas 20 years ago,
yeah,
there were very few offices downtown. In Dallas, there was government downtown, but the offices were out in little spots. Go to LA when you and I were a little bit younger, okay? There was government downtown, but there were no offices. They were out in each of their little niches, all right? And I think that's more of what you're going to see again, except that niche may be a little further out in a burb, because that's where your employees want to live, and they don't want to commute into town.
Right, right. So these numbers, what do you think they go back up to? Do they go up to 80%? You know, 90%? Do we get up that high? Or, you know, I've heard people say that, you know, companies, and Ford, I think, announced this morning they're allowing up to 30,000 of their employees to work from home. So, you know, if you think about most central business district areas, these buildings were financed on the basis of 85 to 90% occupancy. If that drops down to 70%, I mean, that doesn't look very good for the longevity of those buildings as investments.
Well, I think they will go up a little bit after the epidemic while people work out what they're going to do. But I think in the long run, those buildings have to be converted to other uses. There is no, I don't think it's a sustainable office market at the current inventory. And let me give you a good example again, Mike. Let's take San Francisco. You know, if you talk about Apple's not in San Francisco. It's down the burb.
Yeah.
Right? Because they don't want to be in San Francisco. Okay. And by the way, Google's not in San Francisco. What's in San Francisco is government office and a few other people, 3 of which have left during the epidemic. Okay. So that two people have already sold their building and 1 bought out their contract. Now, I thought that was a little bit overdue, because I never thought you wanted to be in San Francisco. I think you wanted to be in one of the burbs outside of it. And that's what the big firms like Google and Apple always did. And even if you go to Austin, you know, they're not putting their offices downtown. They're putting in, again, one of those locations out where it's easy to get to. And I think you're going to see more people leave the Chicago, leave the New York, and you're going to have to find other uses. And even in other cities like Nashville or Atlanta, it's not going to be downtown. It's going to be in one of those niches that's in a perimeter on the interstate or next to the railroad. People can get to it. But if I need to meet you downtown, I can do it.
Yeah. Really transformative changes. You know, it really is going to make us rethink what a city's all about and what drives it.
Yeah. Well, I think what the cities need to do is think about what services they can give to their community and give to the community they want to live in their city.
Yeah.
I think
a lot of these cities, these central business districts will probably benefit by more people who are property owners and living downtown, you know.
Well, if they'll come and live downtown. Now, in the country right now, 8 of the top 10 cities with growth, people are going to the burbs and the peripheral part of the city. They're not going into the city. The problem right now, Mike, I would say to you, is too many cities have thought about how to get more revenue rather than how to think about providing a service that my client would like. All right. And I can tell you that's not just New York, that's not just Philly, that's not just Chicago. I mean, they think their clientele is poor people and homeless people. The problem is the people who pay the taxes will move if you keep thinking that way. And I don't mean that offensively. I worked for Mayor Williams in Washington, D.C. For about 4 years. And, you know, I kept nudging him. You need to remember who pays for things, not just who get things. Yeah. And Milton Friedman said that once. It's who pays for the food stamps, not just who gets the food stamps, if you want an equilibrium.
Funny how things don't really change that much, right?
I think if you forget who's paying for it,
Yeah,
you're going to get some real problems. And I do think sometimes cities think their job is to solve problems, and they are. But the best problem to solve is how do you keep a good clientele in your city?
people that are living there and working there and so on. Yeah,
Living there and working there,
yeah,
schools, services,
yeah.
right?
So we've talked a little bit about the impact of all this on retail. We've talked a little bit about offices and central business districts and so on. How do you feel about the hotel market as an investment segment? I know from my perspective, it's really been a remarkable time. You know, the low level of occupancy, of course, has changed a lot of things. But you know, in terms of the work that I'm typically doing, I'm more likely to be on a development side of things. And I mean, the vast majority of the hotel chains across the country have eliminated almost all of their hotel development people. I don't know how or when new hotel development will actually start to occur. But as a segment, what are your thoughts on the hotel business? And
Okay, well, one of my friends worked at the Cornell Hotel School, and I know some of their alums. And in Asia, one of my good friends out of Hong Kong's son actually works with Marriott chain and manages one of the ones in that Asia area. And he and I agree right now, this would be a great time to buy in the hotel world
yeah,
because we're at the bottom. And I not only think it's going to come back, part of it's going to come back a little bit different than people expect. I think people are going to travel when they get confident that they're not going to die from traveling. Okay. And hotels are going to be part of that. Now, I do believe it's going to be more the entertainment segment and a little bit less of the office segment.
right.
I think firms are thinking, but they were already thinking, the ones I worked with, about how do we allow people to travel less, okay? Because it's a big cost to firms. So I think that both the downtown market and the general business market is going to shrink a little bit. I think the entertainment market is going to increase. Now, the trick is how do you do that? And you know, some people think you're going to package it where you take care of not only the hotel, but when you get there, we've already got the cruise set up for you. Or when you get there, we've already got the visit to Mount Rushmore set up for you. And that I don't know, but I suspect in that market now, some people are going to get really rich because there's some opportunities, Mike.
Yeah, yeah. So the resort, yeah, I'm with you on that. I think the resort hotel business probably does really well coming out of this, just because
Yeah.
people want to get out and get back to doing things and having vacations and so on. But I agree that the business hotel segment is really going to be the one that is in question as to how healthy that's going to be for the foreseeable future. I
Yeah.
mean, there's so many companies and so many employees have gotten used to the idea that they can do this, right? They don't need to fly to Albuquerque to get their work done. They
Absolutely.
can do
Yeah.
this video Zoom call or Teams call or whatever format it might be, and get done what they need to do without having days of travel and all the costs involved.
Yeah,
So
I think one of the things you're going to see is that they're going to bring people into a home office or a particular destination. And then you're going to have some bonding weekends where I get to know you, say, if we're employees. Years ago with Fleet Bank, I ran one of these in Boston, and we brought in like the top 50 people right below the VP from their different offices. And they thought it was about training. No, no, no. We wanted your counterpart in Albany and you were in Providence. We wanted you two to meet each other. So when you called on the phone, you probably answered it because you met me at that meeting.
yeah,
You're going to get a little bit more of that occasionally to bond each other. And then after that, you're not going to travel. You're going to Zoom.
yeah,
And that's going to lower that. The other thing, Mike, and this was already coming, when I go to Hong Kong, one of the hotels I stay in, I never see a person. When I've already done it online, I key in at the front quote desk. It's not a desk. It pops me a card out, tells me what another card tells me what time my room is open, what my room is, and then I go to that room. And then when I check out, I put the card back in. It lets me see my bill. I say, okay, American Express. I didn't see a person the whole time, Mike. Right?
yeah, yeah.
On business travel, you're going to get more of this because you feel safer. You didn't see anybody, Mike.
Yeah, it changes the whole experience, doesn't it? So you visit Hong Kong and you don't meet anybody. I don't.
Well, at the hotel, I didn't meet anybody. In Hong Kong, you meet a lot of
kidding,
people.
Yeah, I know. It's funny how all this changes the experience of all of these segments, whether it's retail or hotel or how we're working.
Yeah.
I mean, this is again, it's really transformative. So let's talk a little bit about what you're seeing in terms of lenders and investors and so on and their focus. We see a lot about, well, the money is looking for markets that have high levels of stability and resiliency and, that have population and growth and job growth. But, they can't all go to those markets. I mean, if everybody's trying to invest in Charlotte and Austin and Dallas, I mean, all that's going to do is make the pricing get to the point where it's not such a great deal anymore. So, there's an enormous amount of money that seems to be on the sidelines. I was reading the other day a report about a pension fund index, and they were talking about how the allocations for pension fund money have jumped from sort of 5% to over 10%. The second thing that was sort of part of the same report that I was reading was talking about how private funding that's sitting on the sidelines, and this is foreign money coming in to be invested in real estate in the US, is like $330 billion. It's like 2.5 times what the usual amount that's sitting out there. So are all those guys going to chase deals in Austin, or are they going to look at things in markets like Connecticut and so on, where you don't have the job growth necessarily and so on, but you could say the Hartford market has got a lot of resiliency and stability. It doesn't have the growth, but it
Right.
doesn't see the decline either, So
Well,
what,
okay, well, a couple of things here. I think first of all, what people don't kind of catch is, look, between about 1970 and 2010, we allowed a lot of jobs to go to China. And we were buying originally $7 worth of goods from China for every $1 they bought from us. Now that's down to about 3.8 to 1. But stop and think about it. They're giving us $1. We're giving them 3.8. Now, they're not spending that to buy goods from us, or we wouldn't be selling them one. They're saving it and buying our treasury bills and buying things in insurance companies, et cetera. So a lot of that money is just what we gave them. Now, if we would get more of those jobs back in the country, then you'd see more of that money developing cities here all across the country, not just in the South, in the Midwest, in the true West. So part of what has to happen is you can't keep giving somebody $4 when they give you back $1. All right. Now, a second part of that is, yes, you're going to get more money in the country, and it's going to be on the L. It's going to be Seattle down to LA across the country up to DC. If you're not on that L, you're not going to get a lot of foreign money. And I don't mean this negatively, but I advise here in London, Hong Kong investors, mostly Chinese investors second, and then Australian investors third. Now, I'm going to say something, and I don't mean this to be rude. None of them can find Connecticut on a map. Okay. And they don't even know Boston's in Massachusetts. They've heard of Boston, but they don't know it's in Massachusetts. Okay. Because it's not hot enough for them to take the time to find it. Now, let me also be fair. They don't know where Liverpool is. Is it in France? Is it in Germany? I mean, is that a northern German city? Because again, Liverpool, it's kind of like Hartford. It's not going anywhere. It's not dying, but it's not going anywhere. So those investors here's the real problem you have, Mike. If they choose something like a Hartford, they might make a lot of money. They won't get much credit. But if they choose Hartford and they lose money, they'll be blamed because they didn't do what everybody else did.
Yeah, right.
Yeah, I'm going to call it, if you'll let me, Mike. When I was young, the dean and I fought. We were putting in 3 computer labs. He wanted to buy IBM. I wanted to buy a different brand because I could get 40% more for my money. And he finally said to me, John, you're buying IBM. Neither one of us can be blamed if something goes wrong.
Right.
And we bought IBM.
Yeah. Yeah. What are you going to put on the front cover of your annual report? IBM or some no-name brand, right?
Well, and these big investors, I mean, I've worked in Dubai. I have worked in London, with a Norwegian pension plan, CIC out of Singapore, et cetera. Okay. GIC, I'm sorry. And there's a little worry that back home, if you make that little side bet and it goes wrong, man, you lose your job. If you bought IBM, if you bought Austin, well, we all bought Austin. We didn't know it wasn't going to work. Okay.
Yeah.
So
the hot segments we're seeing now in terms of real estate investment and the focus on the part of lenders too, I think are the two areas, multifamily rental, apartments, and logistics or warehousing distribution facilities. Those are the two hot segments. You know, if you're talking to an investor or lender about retail or of course hotels or even office in Connecticut, you know, those can be hard sells. There's not as much attention on them. But you know, all the money can't go after apartments and logistics centers. I mean, there's only so much of that out there. So, you know, what happens is does it eventually buy the office space, but buy it or the retail space or whatever other example, hotels, and they just buy them at a discount and assume that if they get them at, you know, a 25% of replacement cost or lower, that they can't get hurt. Is that what the assumption is?
Well, look, I'm going to give you a small example. In Cincinnati, which I follow because I used to live there. I love it. It's a great city. Now, the metro area is now the largest in Ohio. The city itself has shrunk, but the metro area has grown. It's a little bit like Hartford versus our metro area.
Right.
Okay. Okay. If you go back 5 years ago, they were showing about 28% vacancy in the office market. Now, if you looked at their numbers just before the epidemic, they're showing around 16%. Now, it looks like, wow, something happened. Yeah, they decided a bunch of the buildings were functionally obsolete and they took them off the list. Now, I know those buildings, I can take you and walk you through them, Mike. They're fine, but they're never going to be used again because that market went away. Now, you're going to get the same thing in hotels and same thing in some offices. They're not going to get used because people aren't convinced that you're going to rush employment back to Hartford or back to Syracuse or back to some of those locations. I do think you need to remember across the South, they're growing really fast. They're about 38% of the population right now, and they're going to go to over 50%. Now, when you're growing that fast, you're going to need a lot more apartments, and you are going to need more shopping. They're going to be strip centers and other centers, not major shopping centers. So there is still, over the next 10 years, I actually believe you're going to be short of apartment buildings in Georgia, in South Carolina, and in Florida. I think you're going to get price increases that are unjustified because they're not going to build fast enough. Okay?
Mm-hmm. Yeah. You know, it's a real, it's an interesting puzzle for us in some of the work that we do. You know, we get asked all the time what the future is of some of these, you know, vacant shopping centers and so on. And, you know, my comment sort of half jokingly or half tongue in cheek is that it's not that we're overbuilt, it's that we're under demolished. And, you know, I think to some degree, that's what's got to happen. Some of these properties have to just go away. They've got to be taken down or, you know, look, we've certainly seen a number of them converted to healthcare and logistics, warehousing operate. That's great. But again, I don't think you can convert all of that stuff. There's just way too much of it out there. So it's, you know, a lot of that stuff is very well located, the retail stuff particularly. And it could be something else from a productivity standpoint, but you know, can it all be housing? I don't know. I don't know. It's a good question.
Yeah. Well, some of the malls, you know, could be demolished and you could put good housing there. They're actually in some cases located, so they'd be great for multifamily housing because you've already got the interstate nearby, you've got egress, access, you've got all the things you need. You just have to agree to tear down that mall and put in a lot of good multifamily. And I think you will see that in cities that are kind of growing or stable. Now, the problem is, if you're in a city that's shrinking a little bit, take Cincinnati, I can take you to a mall that's been empty over 20 years. Yeah. It's not empty from this COVID, it's empty from when they started shrinking 20 years ago. And it's still sitting there because there's nothing else to do with it.
Yeah, I've seen many of the same properties. I agree with you. So let's talk about, you know, post-COVID going forward and maybe divide it into a few segments, you know, between now and the end of this year, for example, and then sort of 22, 23, and then that longer term, what's the lasting impact? You know, for example, in the immediate term, we're not really expecting to see, you know, travel come back and hotel occupancy come up and that sort of thing. But what's your take on all this stuff? Like, do you see the vaccine rollout really changing the outlook, the overall economic outlook and the outlook for real estate between now and the end of this year?
Well, I think it was, I've been saying, and I'm going to stick with this. I think October and November is going to feel a lot better than March, April, and May. Okay. I think in many cases, university is going to be back in play in September. The kids are going to be there and we're not going to have lots of deaths because people that age aren't dying. Okay. I think by November again, hopefully the end of summer, nearly everybody who wants a vaccination will have it. Now, I'm going to give you a little bit of a negative news. I think sometime between November and February, there are going to be deaths of people who didn't take the vaccination, and we're opening up. And it's sad, but they are going to die. Now, they're not going to be huge numbers, but they're going to be enough that people are going to think about it, but we're not going to close down again.
Right.
The Prime Minister in the UK said, we're opening up in May and we will be open. And what he really meant was, if you don't get the shot when it's offered, we'll take care of you if you get sick, but we're not going to close down again. And I think the whole world's kind of going to do that. Now, once you get through that little subtlety of we're living, and Mike, you got to remember, a lot of people aren't sure if they're going to have jobs when we start normal again. Because if they've kept their job, as I said, like United, because the government told them to keep them on the payroll. But
Right.
sometime starting probably March of 22, April, May, June of 22, look, Delta's got to right size, and United, they're way too big. It's not going to come back fast enough, okay? And so
Right.
they're going to be laying off people. And as you said, in the hotel industry, you know, Marriott's not laid off everyone they're going to once the government quits helping them keep them on staff. All right. So you're going to go through a slow period there. But once that's over, I think you're going to see the economy be pretty robust because people have got that money in their pocket. And I think that will pull other people out of those jobs they lost into those jobs. Okay.
So that's a, if I'm following you here, then sort of the nascent recovery really starts in March of next year.
That's when I think you're going to see a lot of the real boom start. March, April, May of that year is stronger because people right now, it's uncertain, right?
Right. So does that say then that 22, 23 are largely kind of recovery years from an economic standpoint?
Yeah, I think they're the beginning of the strong recovery. And I think you could end up, if something isn't dumb, we could have an 8 or 10 year growth spurt here. Because you're going to come out of this and all that cash on the sideline, as you talked about, and then there's enough money to build those new apartments across the South mostly, but there's going to be a multiplier effect there, Mike. If you start building those apartments for the growth you're seeing and other people had cash for retail, they're going to put people to work. That gives you a multiplier effect. I think we could easily see an 8 to 10 year recovery, good, strong move, unless something dumb happens. I mean, we get an episode with China that scares us, or North Korea does something stupid. You know, I mean, if nothing dumb happens, I think this is going to be an 8 to 10 year beautiful recovery after you get this little bump worked out now. Okay.
Right. So let's talk about the long-term impact on each segment then. Let's start with office. You were saying, you know, you think that a lot of this office will have to be converted into condos or something like that. So that presumably that begins as this recovery starts to take hold and investors come in, buy these properties at lower prices, I guess, and convert them to condos. But let's go down the list. So any further comments on what you see long-term for office, work from home becoming the standard and so on?
Well, as I said, I think here's a couple of, I think work is going to be more not in a downtown setting,
right?
Because the world that required that is kind of going away. Let me give you an example. Finance used to be downtown because it facilitated people-to-people contact immediately.
Right.
And we used to have the actual trading down there, and we had the banks down there. But you know now, Mike, I trade on Schwab. I trade 3,000 shares of stock the other day for $38. Yeah, I mean, when I was a young man, that wouldn't even been one share they would have stiffed me for, right?
Yeah.
Okay. Now, but I don't need to be in New York. I don't need to be in Nashville. I don't need to have a broker in a normal. So what happened was, it wasn't that people didn't like offices downtown. It's that technology broke that bond that I needed to be near the banker, or I needed to be near the broker, I needed to be near the market maker. Well, that's kind of gone away and become electronic. So virtually none of those jobs need to be in the city anymore, and they're moving out, okay? Yeah. There's a whole set of those that are going away, and what people are struggling with, what's going to be the new mode? And I think it's going to be like transportation distribution. All the ships used to come into New York City, the heart of New York City down there, and the Docklands. All of them used to come into London, all right? All of them used to come into LA. However, today, Mike, there's nothing down there in New York. We're trying to make that into apartments and beautiful places to live. It's out in Jersey, where it should be in most cases. In London, it's out down on the river. Then you put what you need in the city, but you keep the hub out. I think you're going to see the same thing with employment. And I think Apple was a good example. They did that initially. So did Google. I don't see any big firms making the city their hub, except for some like banks right now haven't quite figured that out, but they're going to. Okay.
Yeah.
But let's take Prudential Valuation. They're in Jersey. They're not downtown New York. And they've been in Jersey for 30 years,
Long
right?
time, yeah.
Yeah. And so that model, there was enough hanging on from the old finance model, and there was enough government offices downtown to make it feel like, well, it's not going to go away. But underneath it, you could see the land shifting, and it's going to be somewhere else. And that's the trick. And I think it's going to be more in the suburbs of the big cities, and then in the livable cities, like I said, Boise, Charlotte, Nashville. Okay. Because there you can be in the city and still be livable. Okay.
Yeah. Yeah. Well, that certainly changes the office market so pretty significantly from current. So let's move on to retail. You know, the impact of online retail is obvious. As we started out saying, a lot of these malls just have to go away. What do you see sort of past 2023? You know, all these malls get converted to other uses, and the growth in online retail just continues. Do you see that plateauing at some point?
No, I think for a while, I think online retail can double easily in the next 5 years because there's enough space there. Because
Yeah.
if you look in the total market, it's big, but it's not that big yet. Okay.
Right. Right.
And there's a whole set of things that once distribution gets better distributed, that you will consider for online. And I think you and I are going to be trained. We used to go into, say, Joseph Banks or who it was, or a higher end store. Okay, I won't name the one there in West Hartford. Okay, but once we get fitted, you know, we may just go to their online and get that pinpoint Oxford shirt. We're not going to go in the store anymore. Okay.
Yeah.
And I think you're going to see more of that, particularly for men. Now, women, I think you're going to be more specialized stores because they'd like to try it on, et cetera. But I think it's going to be more high end. I think the normal day-to-day clothes, there's a firm out there now that will send you 3 outfits a month. You try them on and you send them back if you don't like them.
Right.
I think there's going to be much more of that, Mike. Okay.
Much more of that. Yeah. Yeah.
Yeah.
So hotels, I think we talked about. I think they come back pretty strong on the resort side, maybe not so strong on the business hotel side. You know, the big hot thing going on here. I mean, around north central Connecticut, I'll bet there is, I don't know, almost 8 or 9 million square feet of logistics warehousing buildings going up now. Amazon is a big driver of that. I think they're building up on Kennedy Road in Windsor is something like 3.6 million square feet, and that's just one building. They have another 1.4 million square feet down on Dayhill Road. So is that going to be the hot market other than multifamily apartment residential and so on? Do you see logistics and warehousing being a hot real estate investment for the foreseeable future?
Oh, I do, but in warehousing, some of the old warehouses are already obsolete. And nobody's talking about it because the new stuff is so hot, we're busy making money. But if you don't have a certain floor height, if you don't have a certain stress concrete, if you don't have a certain electrical power feed right now, your warehouse is obsolete. Amazon won't even talk to you. They won't even give you the time of day to tell you where it is. So those are going to be obsolete. The new are going to be built because it's going to be integrated to help them get that to you the next day or within a day or two. So you're going to get more of that. Now, pretty soon, the Northeast is going to be fitted out. We've been winning because it's coming out of New York, out of Boston. It's coming closer to us and other places that contribute. Now, once that gets in equilibrium, and I'm not sure we're there yet, but we're getting closer to having that, then the growth is going to be across the South because that's where the population growth is going to be. We're going to grow in the East, we're going to grow about 0.5% a year. They're going to grow 5 to 6% a year. So think about compound growth, 0.5% or 5%.
Yeah, I've spent a lot of time in the South, as you know, and I was just in Texas not long ago. And I mean, that corridor from the I-35 corridor from Fort Worth down to Austin, people just need to see that. If you want to see growth happening, I mean, every town along that corridor is building thousands of homes, not just hundreds, but thousands of homes. And they don't blink. When you ask the town planner, how many homes do you expect to see built this year? They'll say, oh, 3,000 to 4,000. I mean, that's, you know, kind of
But I will say to you, Mike, a few years ago, I was down in DC. One of my students, good, great undergrad, got hired by Ryan Holmes. Okay. His job was to supervise new subdivisions, and it was 10,000 at a pop, not 1,000. He was putting in 10,000 at a pop. Now, Mike, we don't do that in Connecticut.
No, we don't.
But I was in Denton recently, last year before the lockdown. I flew down to Denton for something, and up in Denton, it's the same thing. You're coming out there near the airport or off from it, and there's one particular part they're putting in. Now, this is going to grab you. Okay, hang on to your shorts. 22,000 mobile homes.
Mobile homes.
Well, for worker population.
Right. Right.
Yeah. Here in Connecticut, we're trying to serve the worker population with 22,000 mobile homes, right? Well, we're not doing that. Okay, Mike.
Yeah.
But it shows you what they're trying to do to solve their housing problem for workers.
Yeah.
22,000 units.
The numbers are staggering, aren't they?
They just put my socks off. I mean, I couldn't even see the whole damn thing. I go out to see it, and you're like, you can't see it. Just look at the numbers.
Yeah. So, there's been a lot of talk in our area, North Central Connecticut, about the increased activity in the single family home market. I mean, the pricing has gone up. We regularly hear stories from neighbors and so on, and people who are selling homes that, they put their house on the market on Thursday and they had it under contract on Friday for a price in excess of their ask. Do you have any prediction for, so A, there's a low inventory, which
Right.
we've been talking about, and B, the prices are going up. Do you think that's a longer term trend that's going to drive more housing development as people move out of the major cities and look at markets like North Central Connecticut as a place to live and work and so on? Or is this just a little blip, pricing blip and demand blip?
Yeah. Well, I hope it's a permanent, because I think it's one of the most beautiful parts of the country to live in. I think
Yeah,
here
it
you
is.
have a great climate. You and I were joking earlier. My wife grew up in Cleveland. Hey, winters in Connecticut are not bad. You grew up in Canada.
Yeah.
Winters in Connecticut are not bad. On top of that, I have a daughter in Atlanta. I have a good friend in Dallas. Our summers are not Atlanta and they're not Dallas.
Right.
Okay, they're beautiful compared to that. However, I'm a little bit worried that Hartford's a little bit too far out of Boston and a little bit too far out of New York. If I were selling the state, though, I would talk about the great schools. I'd talk about the great housing. I'd talk about the great climate. And that's the things that we've really got right now. What we are hurting a little bit in is job growth and diversified job growth. Unfortunately, and I don't say this negatively, just a statement about how good we used to be. We have no primary industry that's not younger than 80 years. We got an electric boat, and then we've got GE because manufacturing is still here. And then we've got Ciba-Geigy, and then we got Pratt & Whitney. But these firms are all 80 to 90 years old. I mean, they're not the young chicks on the block.
Not the new industries of tomorrow, right?
We one of the things I've asked people, and I don't understand, look, we're one of the insurance capitals of the world, and we got good companies. But I don't believe we have one internet-driven insurance provider.
That's a good question. I'm the wrong guy to ask about that.
Oh, I know, but okay, I'm just telling you, but I know there's one in Indianapolis. I know there's one in Chicago.
Yeah.
I know there's one in Southern California where you can buy insurance on the internet, and then they have field agents, et cetera, but they don't have that home office like we do. Now, I'm a little bit worried that local people think, if we do that, it'll hurt our other business. No, right now, you got to move that way because that's where the world's going. Don't worry about your own business because it's going away anyways. Okay.
Right. That's right. Yeah. We market North Central Connecticut all the time in the work that we do. And, I've taken to sort of joking to be with people that aren't from the area, and they ask me sort of, well, where is North Central Connecticut? And I'll say to them, well, we're about 100 miles northeast of Greenwich. And they'll say, oh, Greenwich, Greenwich, we like Greenwich. And then they'll think about that and say, what do you mean 100 miles? Isn't that Hartford? Oh, yeah. Yeah, that's true. Other than that, though, we're, so it's the best we can do. You try to market it the best way you can. And, when we get people up to the area and we drive them around, and actually I'd spent some time earlier today doing that with a guy from the South who's representing a company looking to invest up here. And he was very impressed, for all the things that you just talked about, the quality of life, the good schools, it's not the best day to show off our climate today, but I mean, he knows that the climate here is much nicer than the climate that he's used to in the South in the summer. So, he gets it. And the proximity to Boston and New York gives us a story to tell. But yeah, it's a struggle. I agree with you. One of the things I like to do when I speak to audiences is I'll ask people if they own a business to put up their hand. And if I'm speaking to an audience of 100 or 120 people, there will usually be 20, 30 people put their hands up. And then I'll say to each person, anybody who's got their hand up, just call out the average age of your workers.
Mm.
And that's a shocking thing to do. I mean, it's a surprising number. I mean, the number of times that I've had people go around the room and I can't find anybody whose average worker age is under 50.
I want to give you,
some of them are 65,
let me give you another one to go with it. That's wonderful about productivity. That's wonderful about living here, but it's keeping young people from coming. Okay. We are a married state, Mike. You look at the marriage rate in West Hartford, in Glastonbury, New Britain, and Stanford. We are married, baby. But the problem is, if you're a young, bright woman graduating from Yale, you're not coming to Hartford to look for that great guy while you're working at Aetna. You're worried there's not enough great guys because you've looked at those damn numbers. So you got to go to Boston, you got to go to New York. And we don't think about that, but that's one of the things that's not letting us pull. One of the GE executives who used to be president made a comment once down in Stanford at a meeting I was at, that he was having trouble getting bright young men to come out to the corporate headquarters because they were afraid there were no girls to date in the area. Now, it may not be true, but it kind of is true if you look at the data. And it's a subtle thing, but in terms of that young person starting a company here, unless they're here already, that worries them a little bit because there's not that base of people to let them look at those things.
Yeah, I don't think Hartford will make any lists of active singles markets, it's
That's right. You understand.
Yeah.
Yeah. Let me tell you a group, Mike, that I would like to push, that I think Hartford area could compete in. There are a lot of firms, service firms, that service all the way from Jersey, New York up to Boston. Okay. Now, I think their corporate headquarters, their distribution center, their main location should be in Manchester, or should be in New Britain, or should be in East Hartford. I'm not going to take Hartford right now for a bunch of reasons, but they should be in the area because that puts them easy distance to New York, easy distance to Boston, and you have a textured market for their employees to live. They can live in Tolland, they can live in Vernon, they can live in Glastonbury, they can live in West Hartford. I mean, you've got a market that serves their different clientele.
Yeah,
okay?
A lot of choices.
Yeah, and even if you had a guy who served mostly New York, well, he can live across the river, come over here in Connecticut, but he still come up to his base in Manchester when he needs that corporate meeting. I would be selling base hits, some singles and doubles here. Quit trying to go for another GE. Put a whole bunch of those in Manchester, in New Britain, in East Hartford. And all of a sudden, you got a body count that's starting to grow again. And it meets the needs of the region and helps us. Okay.
Yeah, I agree with you. I think you build in a lot of resiliency. The number of communities around the country that have lost major employers that's a huge number. I mean, and it can be devastating. You look across the so-called Rust Belt, and I mean, that's behind a lot of the decline in markets like Rochester and so on, where they were tied to one big industry or employer. So, well, lots to think about, John, and I really appreciate you taking the time to join us today. Any final closing comments?
No, I enjoyed it, Mike, and I always enjoy the Hartford areas. I live in West Hartford myself, and I used to, in my earlier life, lived in Glastonbury, so I guess I know the area.
Yeah, you do.
So,
you do.
And I love realtors. I've worked with them for years, so I had a great time today. Take care.
They're a great bunch. I agree. Well, that sort of brings us to the close of this month's session.
Well, Ted Murphy had a question there, Mike, if you can get it.
We've got one question, one additional question here about the analysis of the future market growth. Does it take into consideration the people we've lost due to the pandemic?
Well, okay. I don't think in the whole country we've lost enough people that it will truly affect the growth rate. And part of this is, and it's very, very sad, okay? Most of the people who died are over 70. If you go look at the numbers, it's just overwhelming. Most people who died are over 70. Well, those people weren't working on average. And I'm gonna be an economist for a second, so forgive me. They're gonna leave their money to their kids and their kids are gonna spend it. So you didn't lose spending in some sense. Now, I apologize to her because we economists sometimes are kind of weird about the way we look at things. But remember, they're going to leave that money and the kids are probably going to spend it. So in some sense, you may actually get a small boost because of the segment that you lost. Okay. Yeah. And it's sad to say it, but I'm just being an economist.
No, that's right. No, that's what we need. And we just had a late entry for a question here about Stanford. Any comments about how Stanford will do post-COVID?
Well, I think Stanford, you all know this. I've been a Stanford cheerleader since I've been back to Connecticut. I think Stanford's going to continue to grow. I think it's going to be mostly a bedroom community to New York City. And there's going to be some small corporate groups around Stanford, but not likely downtown. It's not going to be an office city. It never was going to be. I said this to them 12 years ago. They told me I was nuts. And then later, as everybody started moving out, they began to catch that they're not an office city. But I think they're the best suburb of New York City, okay? I think today, they're that New Rochelle of back when, we watched the Mary Tyler show back then, or Dick Van Dyke, okay? Well, now that's Stanford, and I believe it's going to continue to do very, very well. And the trick is for the city to remember to serve their clientele. And if they do that, they're going to do very, very well.
Okay. I'm going to take one last question, and this will be the last question we take, thanks to the audience. But, we're looking at vacant malls. Are elder care facilities a possibility for vacant malls? And maybe you and I can both take a shot at that one. I'll let you go first.
Well, I'm going to say I don't think they're structured properly for that. I may be wrong, because I think elderly care is one of two types. You've got people who want to be active and they want to walk out and around and do things. Malls were not set up to do that. And then second, many of the elderly care are where we have to put our mom and dad there because they just can't, they don't have mobility, okay? And again, I don't think that kind of facility is designed to do that, but I could be wrong. And Mike, you know this world better than me.
Well, my quick answer on that is, as I mentioned earlier, a lot of malls are very well located. I mean, they're close, they're by nature of what they do, they're close to population centers and transportation systems and so on. I think the big issue that is determinant whether they can be converted to any use is what can they be bought for? Right. What's the cost of demolishing the Macy's store that's empty all of a sudden? And what can it be bought for? A few years ago, when these things were selling at, multiples of their net operating income, which pushed the price into, sort of $100 million, $90 million, $80 million. No, you couldn't buy them and convert them to anything else. But when you can buy a major regional mall for $10 or $12 million, yeah, I think you can line up a lot of things that could work on that real estate. After all, it's well located real estate. If you get it for the right price, I think you can make it, turn it into a lot of things, but it's very dependent on what the acquisition price is.
Yeah.
All right. Well, thanks again, John. And I'm going to bring this session to a close. Thanks to everybody in the audience who took the time to join us today and listen in. I want to thank Gina Michelada and Nancy Stickles and the Commercial Council members at the Greater Hartford Association of Realtors. They're the sponsors of this, and they're the ones that do all the work to put it together. Look, we hope it's been helpful. Please send us any topics you have for future sessions. We're doing these, as I said, once a month. The next one will be on Thursday, April 15th, again at 4 p.m. And we look forward to having you join us. John, my friend, great to see you. Thanks again for your time. Look forward to talking to you soon. Good afternoon, everyone.
Thanks, Mike and John. Appreciate it.
Thank you, Gina.
Thank you. All right. I'm going to stop recording.